Hi, friends. So welcome once again. So we're going to the last part of audit, planning, risk, and materiality. Okay, so in the past, we've looked at what risk of material misstatements include. So we're talking of a function of inherent risk and then control risk, okay? And then a function of these risk of material misstatements together with detection risk will give us the audit risk. Okay, so audit risk is the sum or the function multiplication of risk of material misstatement. And that risk of material misstatement is made up of inherent risk and control risk, okay, times detection risk, okay. We ended with inherent risk and we said with inherent risk, we must always hold on, something is happening to my screen. Okay, so we said with inherent risk, there's something that we should always consider. Okay, we should consider at the business level. Okay, at the business level, and then we should also consider the transaction level. So at the business level, we said, let's look at the nature of the business environment, the history of the company, any unusual transactions, cash situation of the company. Okay, cash, we said, is the lifeblood of the company. So without cash, then, we are dead as a company. At the transaction level, we said consider issues like complexity of underlying transactions, degree of any judgment involved in estimating transactions, okay? They also said, how is it easy to defraud the company, okay? How is it easy to defraud the business lines? All right, so let's move on to the control risk. Let's move on to the control risk, and then we can wrap up on this one. Okay. So bigger screen, share the slide, and then I can move on. All right. So the control risk. So simply, we are talking of the risk that there could be a risk of material misstatement due to error, risk of misstatement, okay? Material misstatement due to error or error, yes, material error of misstatement, which may have gone undetected by the client's system of internal control. So we have internal control systems, but it couldn't detect this material error or risk of misstatement or misstatement within the books. Okay. Now, what affects control risk? Once you've heard of the name control, then the first thing that comes to mind is our internal control system. Okay, so the first thing is the internal control system, the internal control environment. Okay, what is the attitude of management towards these controls in the organizations? Do management sanction people who flout the control systems, who override the control systems? Do management themselves override the controls? What is the corporate culture for these particular controls we've instituted at the workplace? Okay. Now, some guys could be very competent in running the controls, but they may lack integrity. So consider the integrity. That's why ethics plays a very key role over here. So consider the integrity of the staff who are operating the controls. Some could collude, okay, and then try to play smart with the system, okay. So again, consider the competency of the staff, those who are running the controls, the management, the staff, the points of contact, those with goal ownerships. Are they competent? Can they run these controls? Okay. Also look at the extent of supervisory controls. Okay. So any control we have, prepare bank reconciliations. There should be always a supervisory one, someone who will review to be sure that you've prepared it in line with the requirements of best practice. Okay. Consider the complexity of the systems. Is it quite easy to walk through, or it is quite complicated like a matrix? You can get lost within the system. Any IT amount involved in the controls, these are factors which we should also consider could affect the control of the system. Okay. ISA 315 is still telling us that let's try to understand the entity. In so doing, we'll be able to identify any risk of misstatement or any material risk of misstatement. Okay. Now, ISA 315 tells it relates to transactions, all classes of accounts. Let me put it that way, to all material classes of accounts. Okay. We are not dealing with the immaterial one. So materiality will play a key role. So we'll be gradually moving into materiality. We've looked at planning. We've looked at risk. Okay. We are now using the risk to jump into materiality and wrap up with analytical review procedures, okay? So ISA 315 relates to all material, the keyword is material classes of accounts, account balances or disclosures, which have not been determined to be significant. Now, any account balance or transaction which is material, if management is saying they are not significant, we have to evaluate what they are saying, okay? We don't accept what they have said on face value, okay? Now, again, regardless of whether it is significant per management assertion or not, once it is material, we need to test it. Okay, we'll look at that again. So it is more of planning issue at the onset. Okay, plan which classes of accounts are material. Even if they said it's not significant, don't worry. Once it's material, we must, as auditors, always include in our planning the extent to which we can gather sufficient and appropriate audit evidence to support the account balances we are going to vouch or test. Okay, all right. So again, like I said, irrespective of the assessed risk of material misstatements, so far as we've identified them to be material per our materiality threshold, we don't leave it, okay? We must design and then implement substantive procedures to validate each material class of accounts, each material account balance, and each material disclosure. Okay, we must always validate them. Now, we cannot miss out on any material items simply because we think the risks we have assessed. Maybe you've done the test of controls and you realize that the risk over there is very low, insignificant, immaterial. It doesn't matter. It doesn't matter. Once we have captured these classes of account and balances and disclosures as material, we must test it, regardless of even if the risk we've assessed are low or unlikely. Detection risk is the risk that, as auditors, our procedures are not robust enough to detect that there's an error or misstatement. Okay, so it behoves on us to design robust and foolproof procedures that could help us unravel any errors or misstatements, even fraud. Okay, now remember, audit risk is a function of these three items: inherent risk, okay, control risk, and detection risk. They multiply each other. Somebody will say they add up to each other. They add to each other. No problem, yes. Whichever way you want to pick it. But remember, the higher the level of inherent risk, then there will be likely the risk that our audit risk will occur. The higher the audit risk, the higher the control risk, the higher the audit risk, okay? So once we realize that the inherent risks are high, the control risks are high, we must try as much as possible to reduce the detection risk. The detection risk is within our realm. We design the procedures. So once we realize that the control risks are high, the inherent risks are high, then as an auditor, we must put in enough effort and do more work as much as we can so that we can reduce the detection risk to be a very low level. Okay, so that in that case, we don't add up to the audit risk. We actually mitigate the risk that, go back one step. Yes, we mitigate the risk of an error occurring, which could be attributed to our work, all right? Okay, so ISA 320, I told you in the previous slide, once again, I'll say it. Take the core text, okay, chapter 10 of the core text, and I said try and read more on the materiality and then performing an audit in using the materiality. Materiality could be considered in two dimensions: quantitative metrics and qualitative estimates, okay? Let's take it one after the other whilst we wrap up on this one. So we have been told in ISA 320 that misstatements are material if individually they could affect the decisions of economic users, okay, or the economic decisions of users. Or if we aggregate them together, they could reasonably be expected to influence the economic decisions of users. Okay, so we're talking financial, monetary, okay? So individually, you pick the items, the transactions, if it could affect the decision-making of a beneficiary, then we are saying there's a material misstatement occurring over there. But if we realize that under the cluster of accounts of, let's say, operating expenses, individually, we may have, let's say, payroll expenses, wages and salaries. We could have electricity. We could gas and electricity or insurance, sometimes the depreciation, okay? So let's say individually, when you pick gas and electricity, it's not material, okay? They fall within our tolerable threshold per the materiality threshold we have set. If you pick insurance, same thing individually, it doesn't exceed our materiality threshold, it falls within our tolerable level. If you pick depreciation, you pick payroll, wages, and salaries individually. But if you aggregate them together, you realize that the entire operating expenses or administrative expenses becomes materially misstated. In that case, we pass an adjustment. Okay, we pass an adjustment. Okay, so decisions about materiality will consider more the size and the nature of the misstatements. Okay, now it is more of a professional judgment. So like I said, depends on the size and then the nature, and then matters material to users of the financial statements as a group. Okay. Now, usually materiality is applied at the planning stage. We run it right at the planning stage. But of course, during the course of the audit, we can revise the materiality. Once we realize that new information is coming in, we can revise the materiality thresholds, okay, to meet what we have, to meet the expectations of our work, or to synchronize with what we have unraveled in the course of the audit. Like we said, professional judgment, it could be subjective. Okay, materiality could be subjective, but we always have guidelines to ensure that it is not extremely subjective. Okay, reasonably subjective. Okay. There are no rules as to what level of error or omission is considered material. But there are guidelines which will guide you, okay? It's a matter of the auditor's skill and judgment. And of course, yeah, if I'm a new auditor on the field, I lack that skill and judgment. So I always have to rely on the skill and judgment of my audit partner who's had enough experience. So when he is setting that threshold, he can always justify the basis upon which he's setting that threshold, because possibly he's been with a client for quite a number of times. So he can apply a higher level of skill and judgment. Now, we should always consider the effect of these materiality on the financial statement as a whole. Will it divert users' attention onto something which is wrong? Okay. We should also consider the disclosure of individual balances and transactions. If they are material and we are disclosing them, to what extent would they affect overall? Or at the end of the day, it comes back to the users of the financial statement. As a group of investors, how would it affect their judgment? As individual users of the financial statement, how would it affect my judgment? Okay. So if there is any disclosure, and this is very important, if there's any disclosure which is required by the Companies Act or the financial or the FRS, then we want to say that this disclosure is automatically material. We cannot omit it. We cannot misstate it, okay? Unless if we should disclose something of this nature, it could mislead the users, then we can omit it, okay? So if the FRS and then CA is requiring us to clearly disclose an item, automatically becomes material. For example, we are citing an example where we are asked to disclose directors' interest in contracts with the company. The CA 206 requires it to be disclosed. Okay. So in this case, you have to disclose its material. You cannot misstate it. You cannot omit it. You must disclose it. Unless we think that if we disclose these directors' interest in a particular contract, it could distort the decision-making of users, then we can omit it with explanation. We are in principles-based, so comply or explain. We can always explain why we omitted it. Once again, I'll ask you to look at performance materiality in the text, but let's quickly run over it here and see. So performance materiality, we normally set it at a lower threshold, okay, for the firm, for the financial statement as a whole, and for transactions where appropriate at the planning stage. The intention why we set this lower level of materiality to test or vouch the transactions is that we want to be sure, we cannot detect everything. We cannot. Some misstatements will elude us. We are doing reasonable assurance. We are sampling some, not everything, okay? So what is the risk that the undetected misstatements, when added to the detected misstatements, will not exceed the original materiality level we set? That's why I want to set performance materiality at a lower level. Every organization has its peculiar name they give to this performance materiality. I'm trying to remember what KPMG used to set. They used to have SMT. Okay, and I've forgotten the detail, okay? I'm sure it may have changed, okay? They used to have SMT, something materiality threshold, which is normally at the performance level. Okay, I'm trying to get the name, the S. I'm trying to get the name as substantive. I'm not sure it is substantive, but every organization has a peculiar name they give to their performance materiality, that lower level of materiality, which is set so that it will guide us to do more in-depth work, okay? All right, so materiality can later be adjusted, like I said, as the audit proceeds, you can always adjust it. Now, before we proceed, you might have heard me saying substantive testing, control testing. Now, what do we mean? Okay, what do we mean? Now, we'll come to that again. We may have heard it in the past. Let me put it in a layman's language. Control testing, we are testing the controls. Normally, you don't find it to be more of a quantitative. It's more qualitative. You are trying to look at benchmarks and standard operating procedures and rules and regulations we have put in place and checking it against actually what happened. Of course, you can get a stack of records and walk through and see, was the approval done? Who did the approval? Is it within the authority level or the approval limits? You see, so we are testing criteria, benchmarks, standard operating procedures, best practices to what has been laid down in the books. Substantive testing is usually quantitative, okay? Usually quantitative. So we are, yes, I'm saying usually, but not all the time, okay? So here we are looking at the analytical reviews, the cast checking, the computationals, okay, the ratio analysis, the analytics, the data, the numbers, the quantitatives, okay? So we always want to do, because we are dealing with financial statements, and we know they are more dealing with economic numbers, we want to do more of these quantitatives to ensure that we're on the same wavelength, okay? Now let's wrap up quickly. So analytical procedures, we've seen it in the past. ISA 520, it's simply looking at study of relationships between financials and non-financial data, between financial and financial data. At the end of the day, the intention why we are studying these relationships is to be able to predict a particular pattern based on the relationships which have been performed or which has been disclosed, okay? So we are always looking at relationships between financial and non-financial, so that we can predict a particular pattern, okay? Now, when do we undertake analytical procedures? You would be hearing planning analytics and final analytics. Planning analytics is at the planning stage, where we want to highlight areas which will require that we devote more attention onto those areas, okay? And at the end of the day, when we have finished the audit, we have the final analytics, okay, to be sure that all the decisions we have made, the forecast, the projections, the analysis jives with what was expected, okay? Any adjustments which may have been passed, we want to be sure these ones have been factored in and everything is working hand in hand as required. And during the audit, we use analytical procedures as part of our substantive testing. Now you know what substantive testing is. I just explained it, okay? So analytical procedures goes throughout the various stages of the audit. Planning stage, during the audit, final stages, we do all of this. The objectives of analytical procedures, like I said, is to help us better get involved in ISA 315, to understand the enterprise, the business operations, and its environment, okay, to be able to identify areas which are of significant risk or significant changes so that we can focus more attention on, okay? Now, we will always keep a record or a schedule of key ratios where we compare these ratios with the financials, with previous years, with interim financial statements. And examples of some of these key ratios are the profitability ratios, the ROCE, operating profit margin, gross profit margin, okay, asset turnover ratios, liquidity measures, talk of the current ratio, the asset test ratio, the cash conversion cycle, okay. And of course, you could also keep economic and external economic industry indicators. In your class test, you will find a similar scenario where we have provided you with some analytics, okay? And then we ask you to interpret some of these ratios, okay? And then use them to identify areas which you think are potential risk, for which reason the auditor must tailor more attention to, okay? So take note of that, all right? When do we perform planning analytics? I told you, throughout the audit, before we start the audit at the planning stage, during the course of the audit, substantive procedure, and then at the end of the day, the final analytics to confirm expectations and indicate areas where we need to perform further investigations or hang up our boots, okay? How do we do it? Compare the information you have with prior years. Compare the information you have with future forecast, with budgetary forecast which has been given to us by the client, with schedules which they have forecasted, which they've given to us. Compare it to other organizations within the industry, okay? Compare like terms to like terms. So that's how we do it, okay? That's how we do it. And then there are, of course, limitations to analytical reviews. Because they are more quantitative, they sometimes ignore the qualitative metrics, which doesn't sound, okay, well. But of course, in recent times, you'll see that AR's, analytical review procedures, have also taken into consideration external indicators or qualitative metrics as well. Now, to be sure that we have a reliable analytical review done, let's make sure we have the reliable data on hand for comparison. We are dealing with quantitatives. Let's get the reliable data. Are the data distorted? Have they been touched? Have they been tampered with? Then our analytical reviews will be questionable, okay? Consistency is not necessarily conclusive. Of course, sometimes you do the analysis, the horizontal analysis, the vertical analysis, and you realize that everything is on course. But you have to always go outside and think outside the box. I remember I did an audit somewhere. I will not mention the client's name. I did analytical review procedures. Everything was jiving in terms of the operating expenses. I forecasted. It made sense. But when I picked the schedule of the client and I tried to do a different test outside of the analytical review procedures, a lot came out. They had overstated their profits by millions of Ghana cedis those days. Those times, cedi was like 1 cedi to the $1. So it was quite significant. And they had already declared profits. People were waiting for their bonuses. So, okay, it's not enough just to rely on the consistency or what the ARs will tell us that they fall within the testing thresholds and those things. So don't rely on them too much, okay? Material items should not be tested using ARs alone. Like I said, do the AR, but go beyond the box and do other forms of testing, okay? Good control procedures are necessary if we want to rely on ARs as our main audit test. So in that case, make sure the control procedures are intact. All right, the rest are all appendices. We've looked at a spectrum of inherent risk, okay? And then we have also looked at factors that could trigger inherent risks, okay? And then again, so these are details, more detailed. I think you can see it. It's very clear. Good. So I'm not going to touch on this, okay? And then this is an example of internal control questionnaire, okay? So we look at the ICQ, okay? Who prepared it, who reviewed it, on which dates, okay? And then you have the flow chart. It could be complex. It can be complex. So this is a flow chart of sales orders and invoicing procedures, okay? Quite interesting. You can see about 22 procedures. So they can be complex, very complex if you're not careful. If you don't understand it, you need to. And of course, you don't have to understand everything. Once you get a flow chart and you don't understand it, you don't have to struggle to understand everything. Go to speak to the client, ask him to walk you through what you have done. They do it day to day, so they understand it. You go in 3 days, 3 weeks, you can't understand it everything. So you need to ask them to walk you through the flow chart, explain the legends that they have plugged in there. What does the inverted triangle means? What does the circle oval means? What does T means? What does A mean? What does N mean? Okay, they got to tell you everything. Then we have the ICEQ, Internal Control Evaluation Questionnaire. They are similar to ICQs, okay? But we'll not spend much time on this. We'll not examine you on this just for your consumption. They are similar. We'll leave it here, and then we will see each other. Okay, so friends, go through these case studies, Sweetie Limited, and there's another case study 6. Okay, please look at these ones. I love them, okay? There's a self-testing questions always. We plug it on the VLE as learning points. So once you look at the videos and review the text, you use those self-testing questions as a guide to be able to understand the module or the text or the topic, okay? And then there's a detailed examination question on 161. If you have your time, please take a look at it. All right. I end here, friends. So that is it for audit risk, audit planning, and then materiality. One more thing I want to tell you. Listen, this book is content heavy. It's content heavy. I admit we are overloading you at this point in time, but we will direct your study. So you don't have to worry so much about what do I prepare for the exams. No, don't worry. We'll direct your study. We'll give you directed, focused study. Because the book is actually, like I said earlier, it's a combination of 2 texts. The ACCA audit and assurance text is inside there. And then the ACCA advanced audit and assurance text is inside that book. At the end of the day, you are exempted from only audit and assurance, not advanced. You have to write advanced as well, okay? So, I mean, why should we test you on something you will not be exempted? So don't worry. Get a free mind, understand what you can understand, and at the end of the day, you'll be fine. All right, I'll see you in the next session when I see you. Bye for now.